Another great macroeconomic issue of this century was the Great Financial Crisis. It was discussed in the first chapter of the last edition of this book. While it is not a part of this edition, I believe that a discussion of macroeconomic issues is incomplete without talking about the Great Financial Crisis of 2008 and 2009. Figure 1.1 shows output growth rates for the world economy, for advanced economies, and for emerging and developing economies separately since the year 2000. As you can see, the world economy has had a continuous expansion between 2000 and 2007. Annual average world output growth was 4.5%, with advanced economies, the group of 30 or so richest countries in the world, growing at 2.7% per year, and emerging and developing economies growing at even faster, 6.6% per year. In 2007, there were signs that the expansion might be coming to an end. US housing prices, which had doubled since the year 2000, started declining. Economists started to worry. Optimistic economists believed that although lower housing prices might lead to lower housing construction and to lower spending by consumers, the Fed could lower interest rates to stimulate demand and eventually avoid a recession. And they did start decreasing interest rates to stimulate spending. Pessimistic economists believed that the decrease in interest rates might not be enough to sustain enough demand and that the US might go through a short recession. Even the pessimists turned out to be not pessimistic enough. As housing prices continued to decline, it became clear that the problems were a lot deeper than economists had originally thought. Many of the mortgages that had been sold during the previous expansion between the year 2000 and 2007 were of poor quality, meaning that they were subprime mortgages, meaning that they were given to borrowers with very poor credit scores. The result? Many of the borrowers had taken too large a loan and were increasingly unable to make monthly payments. And with declining housing prices, the value of their mortgage, which is the money they had to pay back, often exceeded the price of the house itself, giving them an incentive to default on their loans. Well, unfortunately, this was not the worst of it. The banks that had issued these mortgages had often bundled and packaged them together into new securities and then sold these securities to other banks and investors. A security is like a financial instrument that represents an investment of money in a business with the expectation of making a profit. These securities had then often been repackaged into yet new securities and so on. The result is that many banks, instead of holding the original mortgages themselves, held these securities, which were so complex that their value was nearly impossible to assess. Banks here actually means banks and other financial institutions. So whenever I say banks in the future, I'm meaning banks and other financial institutions. This complexity and opaqueness turned a housing price decline into a major financial crisis, something that few economists had anticipated. Not knowing the quality of the assets and the value of the assets that other banks had on their balance sheets, other banks became reluctant to lend to each other for the fear that the bank to which they might lend might not be able to repay. Unable to borrow and with assets of uncertain value, many banks found themselves in trouble. On September 15, 2008, a major bank, Lehman Brothers, went bankrupt. The effects were dramatic. Because the links between Lehman Brothers and other banks were so opaque, so complex, because of the complex mortgage securities, many other banks appeared at risk of going bankrupt as well. For a few weeks, it looked as if the whole financial system might collapse. This financial crisis quickly turned into a major economic crisis. The result? Stock prices collapsed. Figure 1.2 plots stock price indexes for the United States, the Euro area, and emerging economies from the beginning of the year 2007 to the end of 2010. The indexes are set equal to 1 in January 2007. By the end of 2008, stock prices had lost half or more of their value from their previous peak. Even though the crisis originated in the US, European and emerging market stock prices decreased by as much as their US counterparts. We're going to come to this later. Hit by the decrease in housing prices and the collapse in stock prices, and also worried that this might be the beginning of another Great Depression of the 1930s, people sharply decreased their consumption. Worried about sales and uncertain about the future, firms sharply cut back on their investments. With housing prices dropping and many vacant homes on the market, very few new homes were being built. Strong actions were taken by the Fed and the US government. The Fed cut interest rates all the way down to zero, and the US government cut taxes and increased spending. These were all actions taken to stimulate spending and stimulate aggregate demand. Despite all that, demand decreased and so did output. In the third quarter of 2008, US output growth turned negative and remained negative in 2009. One might have hoped that the crisis would remain largely contained in the United States. As figures 1.1 and 1.2 both show, this was not the case. The US crisis quickly became a world crisis. Other countries were affected through two channels. The first channel was trade. As US consumers and firms cut spending, part of the decrease fell on imports of foreign goods. Looking at it from the viewpoint of countries exporting to the US, their exports went down, and so in turn did their output. The second channel was finance. US banks, badly needing funds in the US, repatriated funds from other countries, creating problems for banks in those countries as well. As those banks got in trouble, lending came to a halt, leading to a decrease in spending and in output. Also, in several European countries, governments had accumulated high levels of debt and were now running large deficits. Investors began to worry about whether debt could be repaid and asked for much higher interest rates in return. Confronted with those high interest rates, governments drastically reduced their deficits. This was done through a combination of lower spending and higher taxes. This led, in turn, to a further decrease in aggregate demand and in output. In Europe, the decline in output was so bad that this aspect of the crisis acquired its own name, the Euro crisis. In short, the US recession had turned into a world recession. By the year 2009, average growth in advanced economies was 3.4%, by far the lowest annual growth rate since the Great Depression. Growth in emerging and developing economies remained positive, but was 3.5 percentage points lower than the 2000 to 2007 average. Thanks to the strong monetary and fiscal policies and to the gradual repair of the financial system, economies turned around and started recovering. As you can see from figure 1.1, growth in advanced countries turned positive in 2010 and has remained positive since. Of course, until the COVID crisis. It's important to also look at some statistics of the Great Financial Crisis. 8.8 million jobs lost, unemployment spiked to 10% by October 2009, 8 million home foreclosures, 17 trillion in household wealth evaporated, home price declines of 40% on average, 7.4 trillion in stock wealth lost between 2008 and 2009. There are many lessons to be learned from this crisis. A big misconception of some of these banks was that they were too big to fail. They were certainly proven wrong. But one of the main lessons to learn from the financial crisis is the importance of holding institutions, large and small, including the federal government, accountable for their actions. Making sure that we have the right financial regulations in place and that they are being followed. And indeed, after the 2008-2009 crisis, many financial regulations were put in place so that we can avoid a financial crisis like this one.